Welcome to the Legacy Through Land podcast, where we're dedicated to empowering you on your journey to land ownership and management. I'm Tyler Markham, your host, and each week we'll dive deep into the world of land investing, management strategies, and the transformative experiences tied to owning your very own piece of dream dirt. With our expert guests, inspiring stories, and actionable advice, we're committed to helping you become a better land manager, hone your investing skills, and start building your family's legacy through land. Now, let's dive into this week's episode. We hope you'll enjoy. What is going on, my people? Welcome back to another episode of the Legacy Through Land podcast, episode 28. It's honestly a super struggle of mine to remember what episodes these are, so please don't bust my chops when I get it wrong, because I know I will. But hopefully you guys are having some good weeks. If you're keeping up, we have finally entered into the coveted opening of Ohio bow season. So we've already released a podcast last week about kind of what to expect in the woods and try to help you guys be successful. If you're outdoorsmen hunters who listen to this podcast, we're trying to keep you informed on what I think is the inside scoop on how to be successful in the woods and outside the woods if you're hunting in fields or wherever you may be hunting. So definitely check that one out. But today, I've got a really informative, educational, like you're going to need to strap in and have had at least a cup of coffee, because we are going to talk about the 1031 exchange. And if you've heard that buzzword, the 1031 exchange, and don't really know what that means, or if you've never heard that word, it's a very powerful term that means a like-kind exchange. It is coined 1031 because it is IRS form 1031. And this is what allows you to sell real estate and buy real estate without paying any taxes, because you're saving the gain you have made by transferring it to a new property. So I'm only going to just kind of scratch the surface right now. I mean it. Take a deep breath. Make sure you've had at least a cup of coffee. If you're driving and listening, really strap in. I've got Mr. Greg Smith with 1031 IPX. He's an attorney in the Columbus area that has helped me and countless other of my friends do 1031 exchanges. And we're going to unpack it all. So without further ado, good luck taking notes. Just save it till the end. He'll at least tell you how to get in hold of him. Let's go. Welcome back to the Legacy Through Land podcast. Thank you guys for joining us for episode 28. And I've been looking forward to this one on the calendar for a good bit, because I knew we were working to try and get Greg scheduled to come on and educate us all. And when this is over with, you're going to say, yep, this is one of the good ones. This is a really powerful tool that Greg's going to help teach us about. And I just, again, want all my listeners to know I am as equally interested to learn from Greg as I know you will be once we get started. So, Greg, I appreciate you being willing to be on here with us today.
Oh, thanks so much for having me. Really appreciate it. Yep.
Pleasure is mine. So what I will do is I will butcher what I believe Greg is, and then we'll let Greg tell you what he really is. But Greg's an attorney that happens to specialize in 1031 exchanges. And if you just know those words as buzzwords, which I kind of knew those words as buzzwords in real estate for a long time, it can feel a little intimidating, I think. I mean, it's just that terminology, what it comes from is, I'm guessing, Greg, is IRS form 1031 is where that comes from.
That's right. Section 1031 of the tax code. You got it.
Yep. So maybe he would say this. I'll say Greg's just a really cool, boring attorney that does really powerful stuff with really cool things in real estate.
Yeah, I'll take it. So yeah, we're called a qualified intermediary, and we'll talk more about that later. But the IRS requires you to use a qualified intermediary in a 1031 exchange. And our main job is we have to hold the funds after a sale takes place and before your client goes out and buys the replacement real estate. And then we do the paperwork that keeps the IRS happy and walk the client through the 1031 process and so forth as well. But yeah, so we're called a qualified intermediary, and it's kind of a strange thing that comes from the tax code and the Treasury regulations. So,
well, when we start unpacking these layers here, you guys will see how much benefit there actually is to this.
and how I would say imperative it is that you use a qualified person like Greg to help transact this for you. Because I mean, I've heard of some folks that kind of do some of this in-house or do some of this, with their CPA or whomever, and not suggesting that those connections could not be full through or legitimate, but it's too intimidating for me to not want to work with someone that I just know this is their space, and I'll be redneck here for a second. When we used to flip houses and even before and after, like in anything you do in business, it's kind of like you have a guy for this, and you got a gal for this, and you got a guy for this. And so for me, anytime we start talking about these words 1031, I have a guy for that. And that is just not me saying I want to lean on my own understanding. I'd rather get Greg and my CPA and whomever on the phone to help navigate this than to lean on my own understanding. So we're going to have a lot of fun with this. It's going to be very eye-opening. We are talking about how to I want Greg to preface what his favorite way to discuss or to explain what a 1031 is. But for me, it's how to massively potentially save in tax costs, and it's how to massively benefit from how to structure real estate deals that could stand to have a sizable taxable issue. And that, that's about as butchered as I could get to it. So Greg, if we jump right into the weeds, what is a 1031? What is it?
Yeah, no, that's great. And it's really this concept that you can reinvest into more real estate, grow your real estate empire over time, and never have to pay any state or federal capital gain taxes along the way. So it can be a beautiful thing. But at its most basic level, a 1031 exchange is the idea that you've got this real estate you're selling. It's some kind of business use or investment real estate. And when you sell it, the government's nice enough to say, yeah, if you go out and reinvest that money into more real estate instead of pocketing it, we'll let you avoid those state and federal capital gain taxes. And we can kind of break that down in a little more detail as we go through it, but that's kind of where it starts. And I always like to say the taxes are always worse than people think.
Yeah.
That's one thing people want to know. A lot of people have 15% on the brain. They've heard, hey, the long-term federal capital gain tax is 15%.
Yep.
And they think they're going to walk away with only paying 15% if they do choose to pay the taxes. So the first thing they want to understand is 15% could still be a lot of money on its own.
Yeah.
That you'd rather keep in your pocket and then reinvest rather than give to Uncle Sam. But there are a bunch of other things a bunch of other taxes that can apply as well. So I know a lot
you said long-term capital gain, and so Greg, obviously, then that opens the conversation of short-term capital gain, which could be even worse.
Yeah, anytime you're selling a property in a year or under, you're at a short-term capital gain, and then the taxes are much worse because they're going to do it at ordinary income levels, so much higher than the 15% rate. So yeah, what you're looking at there is first, I know, Tyler, a lot of your clients like to buy and sell land.
Yep.
So sometimes if it's land with no improvements, you don't have to worry about depreciation. But if there are cabins, houses, barns, things you're depreciating over time, or if you're just investing in some kind of, commercial property with buildings and so forth, you've got to consider the depreciation recapture. So when you sell real estate, there's this idea that commercial buildings are given a 39-year lifespan and residential properties 27 and a half year. And that's a great thing. It's a real estate investor because you go buy property, you take that value, so minus the land value, whatever the improvement value is, you get to either divide that by 39 or divide that by 27 and a half, and that's your tax break you get every year.
Yep.
And you can use that to offset the income coming in on the property. So that can be huge as a great tax break for real estate investors. However, when you go to sell the property, if you weren't just selling bare land, that's where Uncle Sam is going to say, wait a minute, hey, your property went up in value, not down. It didn't crumble away. So now we're going to tax you on that. And they'll take the total of depreciation credits you received through the years. They'll tax that at 25%. So that can really take clients by surprise and be the biggest tax in some real estate deals.
So
putting
let me ask
please.
that a second, Greg. That's so. This is so helpful. So I have almost a street knowledge of most of what you just said, but here's kind of what I want to make sure I didn't misunderstand. You said that what we've depreciated on that property, they will look at that as a 25% recapture. So let's paint a picture of a property that we bought. Let's just say it's a 4-unit apartment complex, and we bought it for $400,000, and we kept it 10 years. Well, in 10 years on that apartment complex, we had a 39.5-year depreciation schedule, correct?
Yeah. If it's commercial, it's a 39-year schedule. That's correct.
So in 10 years, we depreciated that. Now we could get fancy, and Greg and I could go down this train of a cost segregation study and how we could accelerate the depreciation, which would make this issue even worse. But let's just say we didn't. We just stayed with the regular schedule. Let's say they depreciated the asset $100,000 in that time frame. Not only did they depreciate the asset $100,000 in what we would call their basis in the property, the property appreciated in value. So am I understanding, Greg, that you're saying they're taking a 25% recapture of the $100,000 depreciation plus a long-term capital gain on the profit? Or are they just taking, here's what your basis was after you depreciated it down to X and sold it for X. Let's say you depreciated it to 300 and sold it for 700. You made 400. Is that how that's the taxable implication, is $400,000?
Right. So you're looking at two separate things there, right? You're looking at the depreciation credits taken.
Okay.
Those will get taxed at 25%. Then you're looking at the appreciation. That's going to get taxed starting at 15%. And then what we didn't even mention yet is there's two other things that make that go up. There's something that was called the Fiscal Cliff Act many years back. That adds a 5% tax to a lot of deals. And then, as everybody has heard of, the Affordable Care Act, or Obamacare, that added a 3.8% tax to a lot of deals. So on more expensive sales or people with higher income, you're automatically jumping off at 23.8% instead of 15% on the long-term federal capital gains tax. Plus, in Ohio, we've got a 3.5% capital gain tax at the state level. So when people have 15% on the brain, often something closer to 30% is a better estimate. And even if it's bare land without depreciation, 23.8 plus the 3.5 to the state is probably the better estimate. So yeah, it's it can be
a
brutal.
lot. Yeah. Well, nobody's allowed to send this podcast to my CPA. She's going to say that I should have already known this, but again, this is why you have really good people. I didn't, and maybe I'm still not fully clear here, but we'll move past this. It's not a huge issue to the conversation. That I didn't understand that when we have that sale, this prospective sale, that there's two different calculations of the, how the revenue is taxed. Is the recapture of the depreciation, then what was the appreciation that you received in the sale? So am I right? You're saying there's two ways that's taxed.
Absolutely. And think about it this way. Let's take a deal where someone bought an apartment complex many years ago for, let's say, $800,000. And the neighborhood never improved. Things didn't get better. The property itself maybe got a little dilapidated. And so many, many years later, let's say they're selling at that same price of $800,000.
Yep.
That person might go to closing and think, this was a terrible deal. It didn't appreciate at all. I'm certainly not going to owe any taxes, right?
Yep.
What they're forgetting, they took $500,000 of depreciation credits through the years. They are going to pay a 25% tax on $500,000. So it's still a lot of money, even though in their mind it didn't go up in value at all. They're forgetting that tax break they were getting each year was helping them to avoid income taxes. So it was benefiting them along the way, even if they forgot about it.
So paint that now comes this knight in shining armor, this hero to the right out to the WrestleMania ring here. We're all in despair here because now Greg's saying that this turd apartment complex I bought in a D-class area that I did no renovations to, and I just took all the cash flow for a decade, didn't touch anything, and now I want to sell it, and I'm going to sell it for the same price I bought it for. And now, not Greg, but someone's going to say, hey, guess what? You're going to have a huge taxable issue here. Now they might need someone like Greg, unless they just want to pay the bill. Because I guess, Greg, the unfun part of you and I's conversation today is, hey, you guys are right. You don't need Greg if you just want to pay the bill. Go ahead. And there's times Greg may say, hey, pay that bill. We'll move this one over here, but pay that bill. Cause I have, I've gotten some coaching from maybe Greg so far, but I know my own CPA has said sometimes we're just going to pay the tax, but let's just say you can't. Greg, let's paint the picture. They can't. You're saying they have a 25% tax bill on $500,000 in depreciation. So I'm not amazing at math, but it's somewhere under $200,000 that they could owe. When they sell that, what could they do? What could they do if they?
Yeah, right. And Tyler, I don't have to be a great salesperson in this business, thankfully. And I just tell people, hey, go talk to your CPA, have your CPA crunch the numbers. Behind door number A is writing big checks to the state and the feds. And behind door number B is go have Tyler find you more real estate, reinvest into something new, and keep 100% of your money working for you. So that's what we're kind of looking at. So kind of the general process would be when they decide, hey, yeah, I've got this property I'm selling, it's got a gain involved, and I'd much rather choose door B and go reinvest it. They're going to call up a qualified intermediary. They're going to call someone like me. They're going to say, hey, I've got a closing coming up. Here's the property I'm selling. We're going to walk through making sure it works as a 1031 exchange. And then it's really as simple as they're going to let us know the title company they're working with.
Yep.
We're going to ask that title company to send us copies of the contract for the sale and the title commitment. And we review those two documents. And then we draft up the exchange paperwork the IRS will require. That's going to include an exchange agreement, an assignment of contract, and a few other things. Because the strange system the IRS has set up here is that the qualified intermediary steps into your shoes as the investor. We become the technical seller of the relinquished property, the one you're getting rid of, and the technical buyer of the new property that you'll be acquiring. And the IRS even says we own the money in between while we hold it, which is a pretty strange concept.
And Greg hasn't even so much as taken me to a college football game on this money yet. I mean, there's so much work he has to do here.
Right.
While he has our money.
Exactly. So it's a really strange system. Now, we'll talk more about this later maybe, but there are types of exchanges where we actually have to go into title to make it work. But the vast majority of the time on your standard 1031 exchange, called a delayed exchange, we don't go into the chain of title. So what happens is we do get assigned into the contract to become the technical seller on the front end. Same thing on the back end on the new contract. But thankfully, we don't have to go on the deed. We don't have to go into title. That keeps things easier. So we'll get the paperwork set up. The client will sign that anytime at or before that first closing. So that's really important for everyone to understand. Once you've sold your property and it's actually closed, it's too late to do the 1031 if it wasn't set up. As soon as you have a
say that for the people in the back. Say that a little louder for the people in the back.
Yeah, right. Once you even have the right to receive the money, the IRS calls it a taxable sale. So we get a lot of sad and frustrating calls where people will call us on a Monday morning. They'll say, hey, Greg, I want to do a 1031. We'll walk through the details. It always sounds great. And they say, by the way, I closed last Friday, but I haven't taken the money yet. Maybe it's still with the title company or I haven't cashed the check. Unfortunately, none of that matters to the IRS. The IRS just says, nope, you closed, you could have taken the money, so it becomes a taxable sale. So you do want to work ahead of time and get that put together.
So we're gonna walk down a road here. And by the way, for everybody listening, I told Greg before we started, I have 0 notes of questions to be asking Greg, because I knew when we get into the hornet's nest, it's just going to be a free for all for as long as he'll let me keep him, because the questions generate themselves. So here's now the question, Greg, because this is something that there's 2 questions. I'm ADD here. So 2 questions are, I want to talk through intent, and we've talked a lot about intent, but right now what we're in, I believe, is let's talk through the timeline. How does the timeline work? What are some important factors? If you guys have been bored in your high school history class, or you were like me and half slept through history class when the Egyptian pyramid timeline was on the screen and you thought, well, I'll get the cheat sheet later. if you have interest in doing 1031s, Greg would probably agree you should almost tattoo this timeline on your arm. Listen intently. The IRS doesn't care if you miss a day. Ask me how I know. So what's the timeline here, Greg? How does this work?
Yeah, no, that's exactly in sequence here. And so from that closing date, when you sell your property with your exchange in place, you've got 45 days to identify what you'd like to buy. And in that 45 days, you're not required to be in contract, but you'd like to be if you can be. So you want to work as quick as you can. In fact, there's nothing wrong with having it all figured out ahead of time where you can close at 2 p.m. on your sale and close at 3 p.m. on your purchase and be done with it.
Yeah.
But if you don't know what you're buying yet or you're not ready to close on it, one or the other, you do have 45 days to identify what you're going to buy. So you're going to fill out a form, send it back to us, say, here's the 80 acres I'm going to buy, or here's the property at 100 South High Street. You're going to identify what you might buy. And then from the closing date, you have 180 days to actually get closed on one or more new properties. So it's 45 days plus another 135 days after that. And there is no mercy there, unfortunately, like Tyler was suggesting. I've heard a lot of crazy stories through the years why people say they get extra time. Sometimes they'll say, hey, my 45th day was on a Saturday, so I get until Monday. Or my 45th day was on Christmas, so I get till the following day. I've heard a million crazy stories. However, there are two and only two ways they give you extra time, and you really don't want either one to happen. The first is they send you overseas to fight in a war. So literally,
I was getting ready to say, I can't wait to hear these two things.
If they're gonna make you fight for Uncle Sam will give you extra time on your 1031. And the second thing is a federally declared emergency, which these happen more often than you would think, and they're usually natural disasters, right? Yeah. They're usually hurricanes, fires, flooding, those types of things, and they happen in every state here and there. And so when that happens and it affects your exchange in some way, the government will give you an exact amount of extra time. Anyway, that's it. Those two unlikely things that don't happen too often, thankfully, that's it. Other than that, it's statutory, it's pure calendar days. You have to get it done in the 45 and 180.
And so making sure that I intimately understand here, on the 45, the clock starts ticking. If we talk about a closing for the first asset you're selling, and by the way, guys, listen, we're going to dive into this. Doesn't just mean land. Land is one of the tricks that I use, but Greg said real estate in the beginning, so it's about to get really cool here. Lamborghinis are not real estate, so skip that. The closing, Greg, is the ticking of the time clock. When we say closing, and this, I want to get like intimately granular here. Is this when a deed is recorded to that new buyer, or when does that clock start? Because you make a great example of lots of times everybody wants to close Friday at 4 at a title company. Everybody does. So, and you know that, every title company dreads Friday at 4 because all the realtors want their money. So did I. We all feel better when we close Friday at 4. We somehow feel like we're a winner, but closing Tuesday is boring. So the question is, if we close Friday at 4, but they don't record the deed to the new owner, I'm just getting granular here. What starts the clock actually?
Right. So the legal boring language they use there is it's when the benefits and the burdens of the land transfer. And what that means is,
oh man,
it's your true closing date most of the time where, picture it when you can receive the money, when you could go take the money from the title company in the form of a check, or they'd be wiring you the money. And when you're in essence delivering that deed to your buyer, right? That's when your closing truly happens. That's the benefits and the burdens of the land transferring. So you don't get extra time because, some closings you'll close on a Monday and the title company may not record the deed for one reason or another till a Friday.
Yep.
That doesn't give you extra time. Your closing was still Monday if that's when you were getting paid. Okay. So it's usually, if today's the closing, today's the day the money would get wired from the title company directly into your account with us as the qualified intermediary. That's your closing date, and the next day is day one.
So probably just easier, safe to say, whenever that wire hits, the clock starts. And Greg, I'm not that old in real estate here, but back in the day, we used to do cashier's checks. So you could even fight that a little bit because sometimes you take that to a bank and they say, oh, we're putting the 4-day hold on this. And so I would try to make the argument of, in this example, well, I didn't receive the benefit until Friday. So how does the clock start? But now we have wires. I don't know any title company that uses cashier's checks anymore. It's all wires. So when the wire hits your qualified intermediary account is when Greg would say, clock has started, correct?
Well, it's close. Now, sometimes you'll close on a Monday and the wire won't be sent to us from the title company on Tuesday. Monday is still your closing date.
Okay.
So one thing we're going to do is always have the title company send us their settlement statement.
Yep.
And so the settlement statement is going to give us the closing date on it. What we're going to do then is send the client an email saying, hey, here was your closing date. We'll tell them when their 45th day and their 180th day is. And we'll attach the replacement property ID statement to that so they've got that they can get back to us within the 45 days.
So then on the tail end of this, I want to ask an also important question. On the 45th day, just so everyone hears this, because I know a guy this happened to, the 40, so Greg.
He's raising his hand.
Yeah. If you're on YouTube, you'll benefit more from that. You have to identify, Greg, how many properties can you identify? You have to close on something, but you can identify up to 3. Is that?
That's right. So that's the first rule. They made some complicated rules here. The IRS kind of always overdoes it. We know that.
Go figure.
The first rule is usually simple enough. It's called the 3 property rule. You can always identify up to 3 properties with no restrictions. They can be any price. And you could go out and buy 1, 2, or all 3, and that can work. And we'll talk more about the numbers and balancing later. But that's the first rule, usually pretty simple. Okay. So people come back to us sometimes, right? And they'll say, well, I want to buy 4 properties or more. Maybe I sold $1 million property and I want to go buy a bunch of $100,000 properties. How do I do that? That doesn't work under the 3 property rule. So the government, in its infinite wisdom, came up with something more complicated called the 200% rule. So that would be, you would take the value of what you sold. So if your sale price was $1 million as an easy number, then your 200% limit becomes $2 million. So if you're that person who wanted to buy a bunch of $100,000 properties, you could name 20 properties averaging $100,000, maybe go out and buy 10 of those, and you would fulfill your obligation and get 100% tax deferral. So the 200% rule can be tricky because sometimes people have one big expensive property they plan to buy, but then they say, oh, some backups, I want some smaller properties.
Yep.
And it becomes difficult to fit 4 or more within that 200% limit. So it doesn't always work. Sometimes you're stuck with 3.
Okay. Yeah. And then, yes, we will definitely get into, I wrote the word basis down because I know this is, Greg has taken some phone calls from me that he probably is like, I don't know that he fully gets it, but we're getting there. All right. So you have 45 days to identify, and I'll just openly tell you guys, we can use any of my transactions as talking points, Greg. It doesn't bother me, but what happened to us was when you guys heard about my sob story about my Illinois farm and that it didn't work out, we had that farm identified as a 1031 exchange. And that's partly how Greg and I have gotten to know each other so well and we don't know each other super well, but professionally, we started doing this 1031 exchange process and we identified that farm. Well, when that deal fell apart, I had to identify more stuff. And a deal hit my desk like 2 days. No, I think a day. On the 46th day, I didn't know this timeline, but when I first sold the Ohio farm that we were going to use the money to buy the Illinois farm, when that Illinois deal didn't happen, I had a deal hit my desk that would have been a beautiful, simple 1031 exchange, would have fit all the criteria, would have just been a perfect Christmas bow. And I didn't identify it fast enough. We missed that date by 1 day to identify that property. So then Greg unfortunately had to tell me, no matter how good the deal is and how beautiful and all that, we didn't identify it as one of the 3. So it can't qualify. And so I'm just telling you guys all this stuff to kind of remember, like, that clock is very important, not only on the day calendar, but he's saying identify up to 3. Well, I think we identified 3, if you follow my chaos here, but it wasn't one of the 3. Illinois was one of the 3, which when it fell apart, it left us a gap, and the other 2 didn't work out. So long story short, I bought a farm. I still bought a farm that we had luckily, thankfully identified prior to the period ending. And we purely did that as we won't need it, but let's identify this just in case. And we were lucky we did, to make sure and get that money successfully parked into a property. So anyways, I know, I intimately know about the 45-day rule now. So ask me how I know. But all right, so we have 45
Right.
days to identify up to 3, and then you've given this 200% rule, and we could probably go down a train there, Greg, but I'm going to assume if this 200% rule thing, and let's say someone wants to buy 10 properties of $100,000 for your example, I'm going to assume, and maybe you can tell me I'm wrong, that they would have to also close all 10 of those in that whole 180-day window.
That's right. You're still stuck with a time period, whether you're buying 1 or 10. There's a creative thing I'll mention later that could help in a situation like that, but we'll wait for a minute on that.
Okay.
But yeah, and you're always stuck with a time limit either way, and you do need to work quickly. So yeah, it's not the everyday exchange where someone tries to buy 10 properties, but we've certainly seen it done, and I've seen people buy even more. Sometimes they're bundled, right? Sometimes you're buying 20 properties from the same seller, so it feels more like one closing than 20 separate ones. But yeah, it gets done sometimes.
Yeah. So we might be jumping around here a bit, Greg, and if this derails us from where you think the conversation should go, you can tell me, let's table this until a bit farther down the road. But
sure.
You said earlier about, this is a real estate 1031, this is a real estate exchange. And so I want to just kind of pull the curtain back that while I utilize this tool in land, I've transacted a lot of other real estate. That's how I first knew about the term 1031. So could you help maybe broaden the perspective for someone on what would apply here if they bought land or bought a house and sold a house first and then bought an apartment complex? Like what all qualifies? What have you seen transacted as went from this to this?
Sure. Yeah, no, that's perfect. And you mentioned a Lamborghini a few minutes ago.
That's not real estate, correct?
That's not real estate, but I do get those questions, and they're not stupid questions. And the reason is that prior to the Tax Cuts and Jobs Act, okay, that was only a few years back, 2018 is when that kicked in. Prior to that, 1031 exchanges could be used for just about anything, okay? Our company was doing exchanges of aircraft, exchanges of business equipment, exchanges of fun things like racehorses, artwork, collectibles. If it had a capital gains tax, it could be a 1031 exchange, with the only real exceptions of stocks, bonds, and notes. Those were never 1031 eligible, but just about everything else under the sun was. So when people hear these called like-kind exchanges, it used to mean a lot more. You weren't allowed to sell your business equipment and buy real estate, or sell real estate and buy an aircraft. So it was different back then. It's become much, much simpler now. And the reason it's more simple is because it's only real estate for real estate.
Greg, I mean, you had me on the edge of my seat. I want to get my pilot's license. I had a plane donated to me years ago. You're telling me I can't buy a plane when I sell a piece of land?
Yeah, I missed those. I missed the aircraft exchanges. They were a lot of fun.
Yeah, when did all this shut down? When give us a time frame?
Yeah, it was 2018. When 2018 started, you couldn't do it anymore because the Tax Cuts and Jobs Act said 1031 is now real estate only.
Those are the good old days. But to answer
the other part of your question, within real estate, it's very flexible. It's any kind of business or investment real estate can be exchanged for any kind of business or investment real estate. So somebody can sell farmland and buy a shopping center, or they can sell rental homes and buy, you name it, a strip center, a office building, medical office. So, anything for anything within real estate. Now, there's a few exceptions you want to know about. The first is it's not usually going to involve your principal residence. And the reason for that is there's another tax break they give you there. It's Section 121, and most of us don't have to pay taxes when we sell our homes. So that's good. But in the end, your principal residence is not considered business or investment real estate. A lot of people look at it and say, gosh, my home is the biggest investment I have. But that's not how the government looks at it.
Yeah.
They see personal use property, not investment property. So that's not going to typically be involved. The next thing is I get a call at least twice a week from someone who says, Greg, I've heard a seminar of yours before. I know a little bit about 1031s. Here's what I want to do. I want to sell my, industrial property in Cleveland, and I want to go buy a beautiful home on Hilton Head Island, and I want that to be a family vacation home. How do I make that work? And at first, you've already heard me say this has to be business or investment real estate. So that Hilton Head property as a family vacation home on its face doesn't work. However, there is a safe harbor, and a safe harbor the IRS put out says, right, if you follow these rules, then the IRS won't challenge you. And what they say is for that Hilton Head property you want to buy, for the first 2 years, you have to rent it out some and limit your personal use. And if you follow their guidelines, they'll accept your 1031. And so what that means exactly is they want to see you rent it out at least 14 days a year in those first 2 years. They also limit your personal use to either 14 days a year or 10% of the total number of days rented. So if you're someone that wants to rent it as much as possible, you rent it for 300 days in a year, now you get 30 days of personal use. But what's beautiful is if you can live with that for 2 years, just 24 months after you buy it, once you get to month 25, you can do anything you want with that property from then on. So you can make it a pure vacation home, never rent it again, or you can even go move into it, make it your principal residence. So I wanted to explain that because a lot of people are interested in it, but it also is important to, I know, something that Tyler is busy with some of the time, which is hunting properties, right? So when you're talking about something like that, if you want to buy land simply as your personal hunting grounds, the IRS may not consider that investment property. So if you wanted to be safe, again, let's say you sold your industrial property, wanted to buy a big, beautiful chunk of land, then...
And if somebody does, a guy, right? If someone wants to buy a big, beautiful chunk of land, Okay, carry on.
I know a guy, his name starts with T. And basically, when you do that, you could follow that same safe harbor that applies to sort of family vacation homes, where you'd limit your own personal use on your land for the first 2 years, not go hunting on it, say, for more than 14 days in each of those first 2 years. And then you'd also need to maybe rent it out to somebody else to do some hunting for 14 days.
Okay.
And by living with that, you could make massive tax bills go away. And again, when you're to year 3 on, now you can do whatever you want with that property from then on and not worry about that tax hit that really came from your whatever it was, industrial sale, rental sale, land sale, whatever it was on the front end that you didn't want to pay the taxes on. So
let's unpack that
cool.
a second. That is very cool. That is very cool. I'm going to pose some practicality questions as the farm manager here, and probably guys listening to this. So let's say we do want to do that, because I work with a lot of business owners that are usually independently wealthy through business, and they want to figure out how to take some of that money, instead of paying Uncle Sam, buy something, like dirt, a long-term investment. So could they buy that dirt in their LLC, John Smith LLC, and could they... This is where I would get a little hung up. Let's say they limit their personal use, which I think could be easy to do. Do they also have to limit their involvement in the land, such as improvements, such as mowing and crop planting and things that would have expenses and have activity show up in that LLC that the IRS could say, well, you're actively, let's say, farming it, or you're having the farm logged, you're actively doing this, or this. How clean and clear is that of, well, I'm not hunting it, you know what I mean? How do you clarify the business activity?
Sure. So let's compare that first with the Hilton Head property.
Okay.
And then I'll make the analogy to the land. So, because it's easier to see with the Hilton Head property, right? So when you've got that, there's people that say, hey, I need to be there to make repairs on my property, for example, right? There's all kinds of things that go wrong in homes or properties. You gotta deal with it. Those days do not count as your personal use.
Okay.
So if you're there working on the property, managing the property in some way, those are not personal use properties, personal use days, but instead it's really about, personal use days are going to be, are you really there on vacation? So now take that analogy to the land, and the same thing would apply. If you're doing something that, let's take the easy example. If you actually do have some renters that come in and rent your land for some hunting or camping or whatever it might be, farming, then any days you're working on the property are not going to count towards your personal use.
Okay.
Now, I can give people a level of comfort too. In 23 years of doing this, I've done many, many thousands of exchanges. I've never heard I've never heard the IRS ask a client any of these questions, nor have I nationwide with our other people in many more tens of thousands of exchanges. It's super rare to see an audit. They don't go after 1031. I've had exactly one client get audited in 23 years, and they looked at 2 exchanges this gentleman did, and they were perfectly happy with everything. So I literally haven't seen an audit problem.
Okay.
So it's not as if someone's going to come knocking on your door and say, hey, how many days did you go hunt on your land? Realistically, they're going to leave it alone. Now, if you want to be safe under that safe harbor, what you really need to do, number one, is pay 14 days of income taxes on some kind of income coming in. Because if you don't have farm income coming in or rental income from cabins or something like that, then it's looking more and more like personal use property. So if you could actually get people to pay 14 days of rental income, even if it's your friends and family, so you have something to pay, that's going to cover you on that part of it. So that's going to make you much, much safer under that safe harbor.
Greg, tell me this. It sounds like even what could be even simpler, something we see quite often in the farms that we transact is, like I've got 2, for example, right now. They've got substantial tillable acreage to them. And if we just put in a yearly tillable acreage lease with the farmer, Farmer Joe that wants to rent it for $150 or $200 an acre for the tillable, correct me if I'm wrong, Greg. I mean, that lease is going to be, let's say $2 to $20 grand, but depending on the property, of income in the year. Wouldn't that be simple enough to qualify that you're getting income?
Yeah, that would almost always cover it. I guess in a situation, if you want to get real picky, and again, I don't see the IRS ever looking at these, but if, let's just say, a small amount of the land was tillable and a large amount of the land was personal use hunting property, then you might have to factor that in.
Sure.
But it's a good point. Anything you can show to show that you're an investor on the property versus someone only using it as personal use is probably going to cover you safely.
Got it.
And then I was going to mention that it's only a safe harbor, which a safe harbor in general means, yes, if you follow it, you can't be challenged, but it is not against the law somehow not to follow it. So in other words, if you don't follow it, all it means is if you got audited, you don't know which way they're going to go.
Gotcha.
If you follow it, you're good. You can't be challenged. If you don't follow it, theoretically, you could be challenged.
Gotcha.
So it's not like you're breaking the law if you go and hunt on the property for 3 weeks instead of 2, but you're leaving yourself open to a little more risk in the super unlikely event of an audit.
Yep. Well, and I'm not here to publicly blur the lines for my listeners, but I can tell you, for me, a hunting day on a farm for me is a very gray area anyway, because I'm working on that farm up until about 2 hours before I want to go hunt. I'm working. Anytime I'm somewhere, I'm working. I'm doing something there, business-wise, whatever, and then I may go get in a tree stand. So kind of, for me, it's very easy to say, if we're talking 14 all-day sits where I'm hunting all day, daylight to dark, right? Like that's a pretty hard thing to say, but there's plenty of days I'm working that I may happen to get in a tree. So I like this. So there's a couple words that I've written down here that I'd love to talk through as well, because something that Greg and I have walked through together, and he is still actively coaching me on this. He might think I have arrived, but I haven't, is this intent idea. Because I think the thing also worth explaining in a 1031 exchange is this idea of intent and the process. And so could you help paint the picture from what does the word intent mean, or if there's even another word you want to utilize to kind of frame this process of, and here's the question that I started with that might help Greg kind of dispel this. He said earlier, you got to hold the property a year. Well, I did a 1031 and I told Greg, like, something came up. This crazy thing happened. These people made me an offer. I didn't expect to sell the property. Just stuff came up. And I thought I had to hold it a year. I thought the words and the terminology was that I have to hold it a year. So from that, Greg, I'll shut up. What does all this mean?
Yeah, no, that's great. Intent is very important. There was a period of time, this is a long time ago, where Congress tried to put a law in saying you needed to own a property for a year before you could do a 1031 exchange. And the law passed one of the two houses of Congress and not the other one, so it never became a law. And that's where it stands. So there's very clearly no time frame. Instead, it's an intent-based test. So your intent is supposed to be to hold the property as an investment property or to hold it for use in a business, as opposed to holding it primarily for resale. So in Tyler's case, he bought that property thinking he was going to hold it for a long time. And like he said, things change. Things can change because your business model changes. Things can change because you find a better property. Things can change because somebody gives you an offer you can't refuse. They just offer you too much money. So in all those cases, it's perfectly legal to sell that property in a short period of time and do another 1031 exchange because it's about your intent. Whereas if your intent is from day one, I want to sell this property as quickly as I can, and the day after you acquire it, you list it on the, you list it for sale, then that could be an issue. An easy place to think about this is something that does confuse people in the 1031 world. It's with flips. If we're talking about home flips, right?
Yep.
So if you're buying real estate and your intent is to fix it up, rehab it, flip it within 3 months, and you want to rinse, lather, repeat, do that over and over and over, the IRS looks at you the exact same as they look at a home builder. If you're a home builder and you buy big chunks of land and you divide it up and you build the homes and you sell off those homes, the IRS is not looking to give them a tax-free business. So the homes are called the inventory of their business, and they're expected to pay corporate level taxes or ordinary income level taxes on those sales. They're not 1031 eligible. They're not capital gain eligible. They take that same idea and they apply it to flippers. They say if your intent is to flip it, where your primary intent is resale, now we call those homes your inventory. We don't want to give you capital gain treatment. We want to treat that like day job income and tax it that way. So, yeah, you get into those issues. Unlike what we talked about with the 45 and 180 days and that being statutory, this is more like the safe harbor where there's lots of gray area. Yeah. And so it's not always totally clear. Sometimes you might legitimately buy a property and you say, well, I need to do rehab work on it, but then I might sell it or I might hold it and rent it out for the next 20 years. So you don't even know on the front end. Or you might buy land and you might say, yeah, I see some real upside on this. Maybe I'm going to clear timber or do something to make the land more tillable or whatever the case may be. And you might think you might sell it, but you also might think you might hold it forever. So There's lots of gray area. The IRS is not going on a witch hunt on these things. It's like anyone who flipped one time would get away with it even if they were lying. But if you flip 10 times in a row and they audit you, are they going to believe you 10 straight times you meant to hold the property forever and instead you sold it in 3 months? No, right? So you got to use some common sense as to what's appropriate in any given situation. But again, I don't see the IRS bothering anyone on these things.
But like Greg has said here, because I used to be a house flipper. So those terrible house flipper guys, it's easy to see their intent. It was easy to see ours, like you said, to renovate and sell as fast as possible. I mean, the model is velocity of capital. That is the model. So in our game of doing land and farm improvement projects, you could call us a land flipper, but I think what Greg, I hope would say and echo is that when something takes us 12 to 18 months, or when something takes us a while, where our direct intent isn't to put this thing on the market as fast as we can, it's to make a long-term improvement. If something else comes along and we sell that property because something else came along, I think it's a lot more stable of an argument than a 3 to 4 month deal if we have a 12 to 24 month window.
Yeah, the longer period of time is always going to help. But if you want to really be safe, get a renter in there, even if it's for a short period of time.
Yeah.
That shows you weren't just rehabbing and getting rid of it. So even if you had a 3-month renter in there, something like that. But again, it's gray area. And the real reason is, again, you could take 5 years to rehab a property, and maybe your intent really was to hold it after that and rent it out, but your business model changes. Something changes again. It's just a better time to sell it. Those are reasonable business decisions. So, yeah, there's lots of gray area.
Yep.
For sure.
Well, so as we continue to stay in the weeds here, and if anybody needs to proverbially come up for air, go ahead, because I'm about to dig you really into the weeds here. I want to pose a question to Greg. Pretend this is you and I's conference call, since we just happen to be on a podcast. Let's say someone buys a property, they do a 1031, and they bought, let's say, 100 acres. And then someone comes to them and says, hey, I want to buy 5 of your acres. I want to buy 5 of your acres, and I'm going to give you a really big price for it. I want to buy 5 of your 100 acres. Can you sell the 5 of the 100 acres? And if so, then what happens to, how do we determine what happened because you bought the whole thing on a 1031?
Right. So, yes, you can do that. And the same rules we were just talking about apply, which, as long as it wasn't your intent to immediately sell 5 acres, someone comes to you and wants to buy it, you can sell that. And then you're in the same position you were, where you can either sell it and pay the taxes on that 5 acres that you sold, or you could do another 1031 exchange. And either way is perfectly legitimate in that case that you're giving me, where someone comes to you and wants to buy that 5 acres. But yeah, nothing wrong with that at all. You can do that. So,
but I'm going to pose another hypothetical here that you paid whatever, you pay 600 grand for this 100 acres. Someone wants to buy the 5 acres for 150 grand. Would you need to do a 1031 because you're not making money in my mind? You know what I mean? You're reducing your basis. I guess it would matter to the 95 acres that's left over, right? How do you shake that out?
Yeah. You're going to have a tax hit on that sale. So you're going to want the 1031. And the reason is that the tax basis from the old property has moved into your new property. Okay, so if you're suddenly selling 5 acres of it, then typically it'll just be proportionally some of the basis moved into that 5 acres. Now, if that 5 acres was frontage that's way more expensive than the rest, yeah, you and your accountant can figure that part out. But in general, it might go through there evenly. So there's going to be a gain in that 5 acre sale, unless somehow you're selling it at a huge loss. And even then you might have to worry about something because of the overall deal.
But if they could make the argument that 5 acres was worth 150 grand when you bought it for 600 grand, that 5 acres was 150 of it, and someone gives you 150, you think your CPA could make the strong argument? Because in this example I'm painting, this happens. I see this happen. Let's say the 5 acres is a beautiful hay pasture home site, road frontage, utilities right there at the road, and then the 95 is all woods. Well, can you sell the 5 acres, you know what I mean, and have can you make that strong argument? I would think you could, that the CPA could say that the 5 acres was sold for what you paid for it when you bought it. How do you do that, I guess?
Well, remember, there's 2 things you're looking at. Because if you're saying this was just a 1031 exchange when you acquired the land, what you bought it for is not the important number. It's what your tax basis was in your old property.
Yep.
Right? Because that's moved through. If there was no 1031 and you just bought a property today for $1 million, then if you sell a portion of that for the same proportion of the $1 million, yeah, you may not have made any money on that 5 acres you're selling. There may not be a tax hit. But when it was a 1031, you've already got a gain in the property from day one.
Yep.
So I don't want to speak for the CPAs out there, but I doubt they could write that up as a sale where you didn't owe any tax. You'd probably want a 1031 again, or you'd pay some tax.
Got you. So this might be a good segue into the next word, basis. I had to learn. There's a lot to learn about basis, and the thing that I would caution any listener who's stuck with us thus far, if you're kind of like can't make a sentence, just table this podcast for a year, and when you are about to make a crazy amount of money and don't really need it, you're going to want to pull this back up.
No doubt.
But basis, I want to caution everybody. I had this false sense of understanding that basis and mortgage balance on a property were the same thing, and they're not. And in 20 years, it's easy to know they're not because you've paid a mortgage off and the property's worth way more. But in the beginning, when you have a mortgage balance of close to what you think it's worth or whatever, it's in my mind it was easy to think, oh well, if my mortgage is X and I sell the farm, I'm only making the number, or sell the apartment complex, Airbnb, whatever. I'm only making the difference in my mortgage balance and the sale price, and that's not true. So to help us understand basis, because this is powerful with the 1031 as well, isn't it?
Absolutely, and certainly you want to start with an understanding. This is very important, that debt on a property has nothing to do with gain on a property. And a lot of people don't understand that, right? They sell and all the money goes to pay off the bank. Well, they don't feel like they made any money. They might have made a ton of money on that property. I've seen a lot of deals like that. Because what it comes down to, your tax basis starts at, in general, you go out and buy a property for, say, $100,000. That's your tax basis. That's what you got in the property, $100,000. If you didn't like it and the next day you sold it for $100,000, I think we all understand you didn't make any money there and you wouldn't owe any tax. Bought it for $100,000, immediately sold it for $100,000. However, when you're going down the line a little bit, things change. So you have to figure out what's called your adjusted tax basis, right? This is where your CPA helps most of us who aren't good at this stuff. And it's what you originally paid for the property. You'd figure out those depreciation credits if it's not just land. And then you're looking at non-expensed capital improvements. So on a rental property, for example, and you put a new roof on it or a parking lot or something, that would be the kind of thing. It might be very expensive. You don't expense it necessarily in the year that you did it. Instead, it's like it added to the purchase price of what you bought.
Yeah.
So your tax basis goes up because of a non-expensed capital improvement. Then you're going to compare that number with your net sales price. So you go to sell the property, you'll have some closing costs like real estate commissions and title fees and so on. So that'll give you your real sale price. And then that sale price compared to that adjusted tax basis tells you how much gain you had. Okay, so that's confusing to listen to, I know, and boring, but that's what you're looking at. None of that, what's important to note, none of that said you owe $400,000 to the bank, right? Because that has nothing to do with it.
Yep.
And even if you're really sitting there thinking like that should have something to do with it, picture this scenario. Let's say I own $1 million property free and clear, and it's almost all gain. I've owned it forever, and it's done really well. I bought it for peanuts, and now I'm selling it for $1 million. It's almost all gain. But the day before closing, I go to a bank, and I say, hey, will you let me borrow $900,000 against this property? They say, sure, we trust you. We know you're a good borrower and this land is worth $1 million or more, we think. They let you borrow $900,000. Then you turn around and sell it the next day. Well, you might only be walking away with $100,000 or less at that point, but you already got the $900,000 in your pocket from the bank. So the debt didn't have anything to do with how much money you made on the property. It just happened to be that you borrowed either to buy it initially or later you borrowed against your property. So a lot of people get confused on that. And Tyler, that leads us right into how do you balance an exchange to get 100% deferral? Because this is something where people are very understandably confused.
Oh, it's for sure me.
And other sections of the tax code do this completely differently. So there's not one standard, and it's very normal that you would be confused. But the basic concept, the basic idea you want to start with in your head is the IRS wants to give you a tax break and wants you to owe no taxes if you go out and basically buy a property of equal or greater value to what you're selling and you have as much equity in the new property as the old. So what does that mean? Well, it means they start with the magic number is that net sales price. So if you're selling a property for $100,000, for easy number, let's say there's $10,000 of closing costs. Again, those are things like real estate commissions, title fees, and whatnot. So now you're down to $90,000. 90,000 is the magic number that if you can go out and buy new property for 90,000 or more, you won't have to pay any taxes. That 90,000 can be broken down of two things. It can be pure cash because you didn't have any debt on what you were selling, or maybe it's only 50,000 of cash because 40,000 was a payoff on the closing statement to the bank. Either way, 90,000 is the magic number, but if
not the 40.
Right. Not the 40. Not sometimes people think the 50. So yeah, they want you not to pocket the cash. They want you to reinvest that as your down payment. And if you paid off mortgage debt, they want you to replace the amount of that debt. And you can do that one of two ways. You can either replace it like most people do with a new loan. So if you paid off 40,000 on the closing statement, go borrow 40,000 or more. You got it covered there. Or if you either don't want another loan or can't get another loan, maybe you're maxed out with what the banks will give you, or maybe you're buying a nuclear waste site and the banks don't want to make a loan on it. In both of those cases, you could provide another 40,000, burning a hole in your other bank account. So now you're buying with 90,000 of cash, even though you only had 50,000 of cash coming out of your sale. That'll cover you as well. So you can always go to more equity in the new property and get 100% deferral. They don't let you go the other way. Let's say you sold a property for $1 million, no debt on it, and you go out and buy a property for $1 million, but the bank wants to loan you $800,000, so you take it. The problem there is hundreds of thousands of dollars are going back in your pocket because you didn't use them towards the new property. The IRS will want to tax you on it. So keep in mind, there's always a way to get where you want to go if you talk to us early enough and let us plan it. Because all you need to do in that situation is sell your $1 million property for cash, buy the $1 million property for cash. Your exchange is over at that point. Now go borrow against it.
Yeah.
So you get to the same place without having a tax bill. So yeah, the numbers can get confusing. And like Tyler was saying, some people think they only have to reinvest the cash. Some people think they only have to reinvest the debt. A lot of people think you only have to reinvest the gain. In other words, I'm selling a property for $1 million, but I only have 100,000 of gain, so I can go use that gain, go buy a $100,000 property or more, and I'm good. That is not how the IRS looks at it. They want to pretend nothing's changed. That's when no taxes due. And my one final statement on this part is, it's also okay to do a partial exchange. It doesn't have to be all or nothing.
You stole my next topic.
Yeah. You sold property for $1 million and Tyler finds you your dream property for $800,000. That's great. You can pay tax on that difference if you want for whatever cash goes back in your pocket or debt doesn't get replaced. But if you had a big gain, you might still do really well on what you've deferred.
Or you can buy the 800 and then in your argument find a $200,000 property.
Absolutely.
Well, buy two, and then you would be qualified. So, yeah, I wrote down partial exchange because I get this question a lot as well. And basically, Greg, partial exchange in layman's terms is that let's say someone wants to take some of their equity at the sale. They want $100,000 of this, huge gain they're going to get. They're going to get $1 million in gain. They don't want it all, but they want $100,000. What you're saying is in that sale, they can exchange 900, take 100. They're going to get taxed on it. Hypothetically speaking, this is something they held long term. It's going to be a long term capital gain tax. And then
That's right.
They roll the 900 forward to something else, and they can do that.
Yeah, so that's exactly where if it was someone that had an $800,000 gain in that sale, that's still a great result. Of the $800,000 of gain, they're deferring the tax on $700,000 of it, only paying tax on the $100,000 they kept. If that person only had a $100,000 gain or less, it wouldn't be a good deal for them because now they're not getting tax savings from the 1031. So you do have to be careful how much cash you keep or how much debt you don't replace, and you need to make sure you're still buying property above your tax basis so you're getting some tax deferral from the deal.
So when we say tax basis, this is something that I had to have Greg's team kind of help me with, and then my CPA and everybody together. determine when we sold our first asset, what was the basis. And this is where my first bit of 1031 heartburn came, because I'll tell you listeners just the quick math here of how bad I screwed this up. Hindsight's 2020. I would have rather honestly just probably not sold this property. What I didn't realize is I sold an Airbnb, a single family home in West Virginia that was an Airbnb. We sold it for $215,000 and our mortgage balance was about $145,000 at that point. So after fees and closing costs and FAT, we about $75,000, let's say, that we made on the sale, cash at close. What I didn't realize is that 2 CPAs prior to the one I have now, they had accelerated, depreciated all the capital improvements we had done in that Airbnb, which was $150,000 in capital improvements. And the beginning of buying it, we bought this property for $28,000 and put, $175,000 of improvements in it. Our basis, not mortgage balance was 140 something at closing. Our basis in the property at closing was $30,000 and we sold it for $215,000. So now Greg's team gets to say, Tyler, you have a $190,000 gain, not a $70,000 gain. You following me here, everybody? Big problem. I didn't realize that. We thought we only had a $70,000 gain because even knowing my mortgage balance was 140, I kept telling my team, yeah, mortgage balance is 140, but our basis is probably close to that. I wouldn't say it's exact, but it's probably close to that because we've done some depreciation. But no, some CPA had accelerated, depreciated the capital improvements with 100% without asking me, 100%. And yeah, problem one of 20. But here I am now that I've made a massive gain. And if you do this math in your head, I made $70,000. Well, Greg could say, well, okay, so I made $70,000 at closing. Well, if I actually made like $170,000, I would have owed half of my profit in tax on that deal. I would have owed half the nut that I made at closing. I would have owed in tax just to sell this deal because of that accelerated depreciation. So this is where the 1031 comes in. Yes, now for me, it was like, well, gosh, now we have like almost no basis that we're carrying forward. And now we've made this huge gain. So what Greg is having to help continue to coach me through is, thankfully we bought a farm for $400,000 or whatever it was. So it qualified up. We were going uphill with everything, but I have a huge gain that I'm carrying forward, a huge gain, like probably $200,000 at this point that I'm carrying, that if I stop this 1031 train, I'm going to pay like 50, 60 grand in tax to stop this. And so Greg was the hard lesson and the talking point through that was when I want to wait till the end, Greg, for everybody to know how much it costs for you to work with them. Cause I want to paint this picture. It's just terrible. It is just horrific. So, I mean, literally had Greg not helped me through this, like one transaction would have cost me 50 to 60 grand. One. Do that math, everybody listening. All right. I know this is deep, everybody. I promise you one day you're going to be like, wait a second, that podcast, well, I need that guy's number. I'm about to get smoked. Yeah, you do. So keep listening with us. Basis. We just talked through basis. The next thing I wanted to circle back to that I need help. Kind of. This one won't be that long of a conversation, but depreciation. The only thing that I think is worth mentioning with depreciation, because I deal with land, and you said it earlier, is everyone needs to listen carefully that the only kicker to land in a 1031 to me or in a real estate transaction is just raw land, unimproved land doesn't qualify for depreciation. There's nothing you can depreciate on land. So you'd say, well, Tyler, why does that matter? Well, Greg could help us with this, but if you go from one asset class to the other, and I've seen people say, well, I want to buy this apartment, I want to sell my apartment complex and then I want to go to land. Well, number one, you probably depreciated the apartment complex a lot. So that's where your big gain that you're trying to protect is coming from. But if you're going to buy land with it, what would be some of those, hey, you should know, Greg, that you would say if someone's going from a depreciable asset in real estate to a non-depreciable, what do you want them to think through? If anything.
Yeah, they're going to want to talk to their accountant early because there can be a lot of things that you and I wouldn't know about with what they did. If they did a cost segregation study, like you mentioned earlier, that can get complicated because if they've done cost seg, and that's where you go in, and if you bought a hotel, you look at all the things that are what could be called personal property instead of real estate. Things like, I don't know, chandeliers and HVAC systems and all kinds of things that you could separate out as different asset classes, get accelerated depreciation, and then take advantage of that in your books for several years. But when you go to sell the property, it does get a little more complicated because you might have to match up those types of depreciated assets with the same thing on the new property.
Yep.
So if you were selling a hotel and you go out and buy land, you might not be able to do that, right? Because there's not going to be chandeliers and HVAC systems and things on that same schedule on the land you're buying. So yeah, you could run into some issues there. If it's just normal depreciation, so you've bought something, you haven't done a cost seg, you haven't done accelerated depreciation in kind of crazy way, you can still defer all your taxes into the land. It's just that, like Tyler said, yeah, those taxes will be waiting for you theoretically. But what I want to throw in there is that's why so many of our clients are doing what they call swap till you drop. Okay, that's a big saying in the 1031 world. Because what you're doing, it's called a tax deferred exchange. You're deferring that bill till down the road. And if you pay it 10 years down the road, you will still come out ahead. And that's the time value of money. That's the same logic as when they tell you, hey, if you were smart, you would have been putting money away from retirement in your 20s and 30s, not waiting until your 50s and 60s, because it would be worth so much more from back then. And it's the same idea. If you pay the tax bill 10 years from now, instead of now with 100% of your money reinvested in that time period, you will come out way ahead.
Yeah.
However, I still don't want to see you pay that tax bill. Instead, always grow your empire, always use an exchange if you want to sell a property. Then it becomes a tax home run when you do pass away. So when it gets into your estate, the estate will owe no taxes and your heirs will owe no taxes. So if you leave a property to your favorite daughter and she says, oh, great, mom, thanks, mom or dad, but I don't want to manage this land, or I don't want to manage this apartment, or whatever it may be, she sells it the next day, that's 100% tax-free money to her. The taxes do go away with death.
So how, Greg? I was thinking you were going to say we needed to put this in a trust or something like that. Are you saying there's something with a 1031 that sets that up?
It's not actually special to 1031. It's any real estate you own. So even if you haven't done a 1031 exchange, but you own a farm, you own an apartment complex, you own whatever it may, your principal residence, when you die, that tax goes away. Your heirs get what's called a stepped up tax basis. So if you had bought the property for $100,000, but by the time you die, it's worth $1 million, your favorite daughter gets it at a value of $1 million, just like she paid $1 million for it. And if she doesn't want it and turns around and sells it for $1 million, 100% tax-free money to her. So it's just a home run that applies to real estate. So occasionally, Tyler, I get the call from someone who's 90 years old, and they say, I'm being told I should do a 1031 exchange from my advisors, Greg, but I don't want to because I feel like I'm leaving a tax burden to my kids. And I say, it's exactly the opposite of that. Yeah. If you just sell now and pay the taxes because you think you're doing the right thing, paying the taxes while you're alive and then leaving what's left to your kids, you're doing them a disservice.
Yeah.
Because if you just reinvest into more real estate, then it's going to be 100% tax-free to them, and they'll get 100% of the money. So, yeah, it's really interesting, but it's just a great tax break for real estate.
Well, and here's the kicker that I missed, Greg, because once you got on that talk track, I was fully following you. My stepdad was a real estate attorney and a circuit judge for 16 years before he retired. And something he always told me, and listeners need to listen. This is what Greg just said, and I'm going to give it in layman's version. You sometimes think we're all doing our kids a favor or ourselves a favor to deed a property over to them before we die. Deed it over, and we're not. You're not doing them a favor. And I learned this the hard way. So many times I hear this, see this. I work with sellers who I unfortunately have to tell this to, where they're like, oh, no, you don't have to worry. This property's been in my name for 20 years. The mom and dad deeded this to me when I was 18. Well, mom and dad, that was noble for them. They meant well. Here's what they did, though, and Greg can articulate this better. You picked up their basis when you bought it from them. Am I wrong, Greg? Whatever they paid for it was the basis you picked up when they deeded it to you then, 20 years ago.
That's right. It's going to be seen as a gift. And when there's a gift, you take over their tax basis. So it's the
Which is
opposite
zero, let's say, usually. Let's just say it easily, everybody. Is $0. Zero basis.
It's very, very low most of the time. And yeah, it's the opposite of swap till you drop, where the tax goes away. Instead, you're going to get hammered. And so, 99% of the time, it's a horrible idea for parents to put a kid on real estate with them, put them on title with them. It does so many bad things. It's not just the tax ramifications, but let's say your kid ends up getting into trouble financially, and all of a sudden they've got they've got creditors coming after them for all this debt they owe.
They've got collateral.
They can go after that real estate that you put into your kid's name. That's not good, especially when it's mom and dad's principal residence.
Yep.
So there's a lot of good reasons not to deed property to your kids, but the best is the tax benefit you get from just leaving it to them in your will, your estate, and then they get it tax free.
And the thing that Greg is covering, I want to make sure we use the easiest words we can here. This is how I explain it to a seller. When they deed it to their kids 20 years ago, or whomever that I talk with, they gave it to their kids 20 years ago, and they have no basis, and they're trying to sell it to me for $400,000, and they're asking me what kind of a tax implication they're going to have. Number one, I always tell them you need to talk to a CPA, but knowing what you've told me, you're going to have like a $400,000 tax implication. What I tell them should have happened is that if the parents had passed away and they inherited the property, they get a stepped up basis. That's what Greg is saying, is that they get a stepped up basis. What does this mean? It means when they died and the property was given to them, then they took over the basis that the market said that property was worth that day. Am I right, Greg? That's the stepped up basis. And why does that matter? Is because we're all going to be able to make an argument to say the farm you want to sell me for $400,000 is worth $400,000 today. So when you sell it to me for $400,000, you have no basis. You have no gain. You've made no gain because you took a stepped up basis. If you inherit it, if you have it deeded to you prior, you pick up their basis, and it's way low. So that's the distinction we're talking about here. Now, something we could also go. I'm going to bring on a trust attorney, Greg, at some point to talk through like trusts and structuring trusts, but. Staying on the 1031 today, that whole depreciation train was just to kind of give you guys the vernacular that it's not that land, to me, I won't ever say that land is a bad idea to do a 1031 on, but if you have depended on depreciation from a multifamily asset or a triple net lease complex or strip mall or whatever, and that's been part of your tax strategy, like Greg said, you really should ask a CPA because, you're moving the money over if you just go to unimproved land, but you're not picking up any depreciation. That depreciation schedule stops unless you go build structures on it and, start it back and all this stuff. So it can get a little bit more complicated. There's another word, Greg, that we're going to talk through. This has been really fun. We're going to talk through another word. We have 3 cool words that I think with Greg that kind of start the there's thousands, but 3 that start the empire. You have just 1031 exchange, to me, 1031 exchange. Then you have partial exchange, and we've talked about partial exchange. Not that sexy. Just, hey, I want to take some money and exchange some of it. Then there's this other one called the reverse exchange. Now we're just really going to get people confused. So can you go through the reverse exchange?
Absolutely. So I mentioned earlier that in most exchanges, we don't have to go into the chain of title, which keeps things simple. And so most exchanges, people sell property first, then they go out and buy their new property within that 180-day period. So in a reverse exchange, either by accident or on purpose, you want to buy your new property first. Sometimes it's because there's hot markets and you want to be able to get your new property, and then you're confident you can sell the old property within 180 days after you buy the new property, and you would prefer to buy first and sell last. Or sometimes it's really simple as you're planning to sell on a certain day and buy a little bit after that, but your buyer flakes out or their lender flakes out or something happens to delay your sale and you end up having to buy first.
Yeah.
So the gist of this is that the IRS does give you a way to buy first, but I have to say they don't make it especially easy. Okay? What's not easy is that they will not allow you to own the old and the new at the same time. And if you're buying first, they have to give you a way around that. So what they came up with is called an accommodation title holder. What that means is typically our company as the qualified intermediary, we will set up a new LLC called the accommodation title holder. We will go into title on your new property on your behalf when you're ready to close on it. Now understand, we're not going to pay for it for you. So you're still bringing the money, or your lender and you are bringing the money, but we go into bare legal title. You'll have full control over that new property from day one, so you can do whatever you want with it from the get-go. But, we go into title. Then from that date, just like in a regular exchange, you've got a 45 and 180-day period. You've got 45 days to identify what you're going to sell. For most of us, that's very easy. We don't own a zillion properties. We know what we're trying to sell.
Yep.
Sometimes for certain players out there, that's complicated and they have a lot of things they're trying to sell. But for 99% of people, that part's easy. The harder part sometimes is getting it sold within the 180 days after the purchase. During the Great Recession, we certainly saw some failed reverse exchanges where people just couldn't get their properties sold. In recent years, it hasn't been much of an issue. People almost always get their property sold in that time period. But you have to build in that risk. If you think the property you're selling is not, a hot commodity at the moment, and maybe it won't sell in 6 months, you have to think about that.
Yeah.
And Tyler, I know you said you were going to mention it later, but it's kind of a good time to mention fees.
Bring it.
Okay. Yeah. So in a standard exchange, the fees generally are not going to rock your world. We charge $1,000 to set up the exchange and handle the sale. We charge $250 for the replacement property purchase. So 90% of exchanges have a total fee of $1,250 when all is said and done. So we think that's very reasonable for what we do.
$1,250, and in one transaction, he saved me 50 to 60 grand. Yeah, you guys do the math. I think it's a pretty decent ROI. So,
yeah, it can be pretty reasonable. And we think, again, for what we're doing, walking you through the process, reviewing the contract and commitment and working with the title company on the sale, dealing with your identification, working with the title company on the purchase, reviewing the contract commitment, drafting 3 different sets of exchange documents really in total between the sale, the purchase, and the ID, et cetera, helping you out afterwards, helping your CPA and so forth. We think it's pretty reasonable. Now, it's more significant, so that's what we're building to.
Yep.
It's a more significant fee when you have to buy first because of the fact we have to go into title on the property.
Sure. Yeah.
You actually don't want to be in title on other people's properties, believe it or not. If you're not making money from being in title, from the appreciation, you really don't want to be there. The reason is that we do enough of these nationwide where bad things happen, okay? Bad things could be you own a McDonald's in Phoenix, someone gets run over and killed in the parking lot. Well, guess what? If IPX is in title, IPX is LLC, we get sued. We're the owner. Yep. We got to hire attorneys to deal with it, even if we have indemnifications in place and all of that. It's expensive and it's cumbersome and it's time consuming. That's not the worst thing. Bad luck things happen. The worst thing is actually the EPA. And this applies a lot to land deals. Sometimes there's land where people have forgotten or nobody knew or what have you, but there was some environmental problem at some point. And it could be, the nearby gas station, or it could be underground tanks, or it could be a million different things. But the EPA can go sue anyone in the chain of title. And so when we were in the chain of title, they come after us. So there's lots of things you have to worry about. When you're buying, that's a good place to point out, if you're just buying sort of farmland or, land with nothing, let's say, unusual about it, our company can usually waive the phase 1 requirement in a reverse exchange. A phase one environmental survey is what can be done to tell you, yeah, there's no nuclear waste, hiding under your soil. If your property, again, is sort of next to a gas station or those kinds of things where we're worried about some kind of contamination, we're going to say, yeah, you need to go have a phase one and convince us it's clean before we go into title. Because, yeah, we can end up in some lawsuits by accident, but we don't want to end up in one where we should have known it was coming.
Yeah, for sure. Yep.
So most farm deals, it won't be an issue, but some, it could be a problem. Yep.
So what's you might have already said this, Greg, what's the fee structure to do a reverse?
Yeah, thank you. So basically, it's based on a few different factors. It's based on the value of the property we're taking title to, because the more expensive, the more risk to us. It's based on whether it's commercial or residential.
Okay.
And it's based on whether a lender's involved, because lender deals are more complicated. We have to spend quite a bit of time walking them through what their paperwork's going to look like. Because again, our entity could be in title for the first 180 days. We can sign the note and the mortgage and all that stuff, but it ends up being non-recourse to us. We don't want to make your payments for you. And then they'll have you sign everything as well.
So you don't want me to decide I don't want the deal after 90 days and you guys just have to send it to the market.
Yeah, I mean, by all accounts, we are deeding that property back to you or transferring the LLC membership interest to you. We're going to do that day 180 no matter what. So it never gets stuck with us. But, okay, to get to the fees. So on a residential deal under $1 million in value with no lender involved, like someone's just buying a $500,000 rental house, the fee is going to be $6,000.
Okay.
Plus the state filing fee for the new LLC we have to set up, which is, in most states, a couple $100 or less.
Yep.
So that's the low end. On a really expensive commercial deal with a lender involved, it could be a few $1,000s higher than that.
Gotcha. Well, and so really the easy way to say this is, hey, if at all possible, have this lined up to go through a standard 1031 exchange, not require a reverse. And I'm sure Greg sees it. I mean, stuff comes up. I'm sure I'll come to Greg at some point in my career and say, hey, this place or this asset came for sale that I never thought would come for sale, and I got to buy it. I got to strike, but I'm going to go sell this to make this whole. And still yet, we're all going to, you're going to assume the asset you want to sell, you've been holding because you have equity in it and you don't need the equity. So if it costs $6 to $8 grand for Greg to help you protect that equity and transfer it into the new asset, I really think it's worth it. I can't say enough how worth it I think that is. Well, I mean, I guess, heck, for all you listeners, go test me and see if it's worth it or not. Ask your CPA. You can give $6 to $8 grand to Greg, or you can give $600 to $800 grand to the IRS. So.
Yeah. I will give one warning, and it's that this conversation has happened way more often than you would ever think it would. Where I'm talking to someone, the 1031 makes total sense. Like literally on Monday they're selling a property for $500,000, and on Friday they're buying a property for $500,000, and it's a no-brainer 1031. And sometimes they'll come back to me and say, hey, my accountant said I should not do this. And I'll say, did they explain why? And no, not really, or I didn't understand. And I'll say, well, can you have your accountant call me? And the accountant will call, and I'll say, yeah, I just want to make sure I'm not missing something. Why are you telling your client not to do this? And the accountants will admit to me. This has happened many times.
I already know where we're going. This is why I've had
Greg,
5.
I told him not to do the 1031 because I don't understand 1031 exchanges, and I don't want to have to do the homework.
There you go.
And it's like, you're just kicking yourself, and you're saying you're really going to do that to your client, make them pay a bunch of taxes they don't have to pay.
Just because you don't want to do the paperwork. Yeah.
And I'm like, I can help you through it because you can figure out tax basis. You're an accountant, you know how to do that, and the rest is going to be simple.
Yep.
So, but I've had that come up so many times that you do have to understand. There are a lot of accountants out there who are very good at what they do. They can't possibly know everything.
Correct.
I mean, one section of the tax code is complicated enough. I deal with one section. You could get 10 different opinions from 10 different experts sometimes, right? So to know the whole tax code is insane. So I'm not holding this too much against these accountants, but they need to ask for help when they need it.
Yep.
And they don't want to put their clients in that position. but just know that's a possibility, because I've heard that so many times through the years where they really should be exchanging. The accountant tells them not to.
Well, and I'm really glad that Greg went here because, I can rant for a second. Having done real estate since 2015 full time, I know for a fact in bookkeeping cleanup and in tax bills that I've paid that I didn't think I owed, but the CPAs weren't qualified enough to help navigate through some of these things. I know I've paid at least $150,000 in errant fees, bookkeeping cleanup, all because I didn't have the right people helping me. And I paid a $17,000 bill this spring, $17,000 for a bookkeeping cleanup, to leave one of the top real estate bookkeepers, guy that speaks on stages, keynote speaker, one of the top people, to leave their firm and go to another firm, $17,000 before the firm would even accept me to be a client. So I'm telling you, when Greg says what he's saying, you really need to listen. I think some of the hardest things to find in business, I've got a really good friend, my neighbor's a banker, and as much as I like to bust his chops about being a banker and, working from 10 to 2 and, there's full weeks in a year. I don't know if he knows this, but anyways, he said, there's 3 things you need. You need a good CPA, you need a good attorney, and you need a good mentor. And to me, or accountant, there's, to me, the ones you have to have is you've got to have a good CPA. You've got to. It's incredibly important. And I would say you have to have a good attorney. And in this regard, I would say Greg, to me, is almost the marriage of that thing, because he can talk to both about how this should look. And so I'm glad you went there. Cannot echo you enough. Just because someone in your current sphere of influence says, "Oh, no, this is scary," a confused mind says no. I would ask you dig deeper, because you might be getting to the truth you actually need to hear. Whereas Greg's already said they'd be willing to help. I mean, this is a huge taxable implication that people are usually within.
Yeah, absolutely. Right.
Yeah.
One thing I want to mention, Tyler, because you said how sometimes this can be big and scary. Hopefully I can make it a little less scary for the audience. That one thing we do as a company, we offer free consultations. All right. If you want to call us up and ask about a situation, say, I'm thinking about selling this, I might want to exchange and go do this, we are happy to talk that through with you, tell you the things that work or don't work based on our conversations today. We never charge anything for those consultations, okay? Only if you end up doing the exchange, you do a sale, the money gets wired to us. Once the funds are in the exchange account, we're going to deduct our $1,000 fee.
Yep.
And before we wire the funds for the purchase, we'll deduct our $250 fee. But that's the only way we get paid. So don't hesitate to call us, email us, whatever, with questions. We're not going to bill you by the hour or make it intimidating. We'll try to make it as clear as we can and tell you what works and doesn't work.
And I can echo that has been absolutely my experience with Greg. And that's why I brought him on here. And that's why I knew he'd be a wealth of information. It's been incredibly helpful to work alongside of he and his team to navigate some of these things. So I can echo that firsthand experience. It's been that exact experience that all I have paid Greg for was transactional work. I've not paid for any consulting that saved me hundreds of thousands of dollars. I've not paid for any retainer, anything like that. So Greg, this has been amazing. Before I say how do people get a hold of you, are there sectors of a 1031 that maybe we haven't nuanced yet that I just hadn't thought of?
I think we've hit the best and most important topics.
Okay.
We've even got, like you said, we've even gotten to the weeds on a few things, which is great. So We've talked about some basics for people. We've talked about some more advanced topics. Anyone who wants even more information, call me or email me. I can email you a book, or you can go and get it off our website as well. There's a ton of information out there, and you can definitely read till it puts you to sleep, because it is the tax code. But I think we've hit the best points for today. You've done a great job, and kind of amazing if you were winging this a little bit, Tyler, but you did a great job driving this along.
Well, as boring on paper as a 1031 may be, or IRS code or whatever, I will say it is equally as exciting on the other side to navigate these things. It's exciting because there's a deal involved. There's usually two deals involved. So you're really needing to navigate how to successfully reposition yourself, because the thing about real estate that is a blessing is that oftentimes there's a sizable profit. Oftentimes there's a big number involved with a sale. And as exciting as that can be, it can also cause a lot of heartburn if you've got a huge taxable implication. So this is like an invaluable tool to have in your belt. So the pleasure has been mine, Greg. This has been really fun. Last thing here. How do people get a hold of you? What's an ideal client look like, and how do they get a hold of Greg?
Sure. Anyone who wants to sell real estate's an ideal client. And I guess you can call or email.
Okay.
Do you want me to give that information now,
if you
Tyler?
give it, and then I'll put it in our show notes as well, so that anyone who wants to reach out can. Where's the best place they should connect with you?
I appreciate it. I'll give my toll-free number first. So that's 866-443-1031. I'll give my local cell phone number. 614-477-1301. So I didn't get 1031 there. That's a long story, but they kind of messed that up. So that ends 1301, unlike the toll-free number.
He didn't identify that number within the 45-day period is what he's trying to say.
Exactly, right? So then my email address I'll give you as well. Greg, Greg, .Smith. You can probably handle that, SMITH. And then it's @ and it's I as in investment, P as property, X like x-ray, 1031.com. So in whole, that's greg.smith at ipx1031.com. And like I said, feel free to reach out anytime.
I love it. Greg, I really appreciate you being on today. Listeners, if you've listened this far, congratulations. You can now take a drink, come up for air, feel dumber in real estate like I did, but also feel equally empowered to go out and do your next deal and help save yourself a little money on the taxes. A little bit of DJT going on in here. So, Greg, thank you again for being here. And if you guys have enjoyed this week's episode, go share it with somebody. Send me a comment. Shoot me a message. I do a lot of these episodes, and I have 5 or 6 fan people that do message me and tell me how great they were, and I love those. But I don't really know how things are going on the other end. So if you would take 2 seconds to tell me how this impacted you or how you liked it or what we could do better, I would love it. And until then, we'll see you next week on the Legacy Through Land podcast. Peace.
And that's going to wrap up this week's episode. If you're finding value in this content, we'd love to hear from you. It'd mean a lot if you could share with us how this podcast is helping you on your journey and let us know of any topics you'd like us to cover in the future. Be sure to connect with us on all social platforms at Legacy Acres Land Co. and subscribe to stay updated on when new episodes drop. We hope you've enjoyed this week's episode of the Legacy Through Land podcast, and we'll see you next week.